Toronto's mortgage market just hit a milestone, one that nobody wanted. Delinquency rates, meaning homeowners who are 90 days or more behind on their mortgage, have surged to between 0.22 and 0.24%. That's the highest in more than a decade. In just the first quarter of 2025, the rate climbed by a staggering 71% compared to the same period last year. For context, Ontario now has over $1 billion in delinquent mortgage balances. Toronto and Vancouver have blown past their pre-pandemic levels from 2020. And get this, less than 3 years ago, Toronto's delinquency rate hit a historic low, just 0.06%. Now it's more than tripled, outpacing other major Canadian markets. So what's behind this dramatic reversal? Let's break it down. First, mortgage renewal payment shock. Back in 2020 and 2021, tons of homeowners locked in ultra-low rates, sometimes under 2%. Now, they're renewing at rates above 4%, and their monthly payments are jumping by hundreds of dollars. That shock is pushing even stable borrowers into arrears. Second, the market itself isn't helping. Inventory is piling up, especially condos, but demand just isn't there. If you're missing payments and need to sell, you might not be able to, leaving you stuck in arrears for longer. Then there's rising consumer debt. Ontario's non-mortgage delinquencies, think credit cards and personal loans, are up 46% year over year. In Toronto, over 2% of these accounts are now 3 months overdue. If household finances are stretched that thin, missing a mortgage payment gets a lot more likely. Another factor, private lenders. They now control about 20% of Ontario's mortgage market, and default rates here are 5 to 10%, way higher than banks. Many of these loans are already headed for power of sale. Why does this matter beyond the headlines? First, there's stress on the financial sector. When defaults rise, banks may tighten lending and hold more cash in reserve, making it harder for everyone to borrow. Second, the housing market itself could soften further. More defaults mean more forced sales, which can drag down home values, especially in suburbs and investor-heavy neighborhoods. We're already seeing some investors exit as rents can't keep up with rising mortgage costs. Third, household vulnerability. As more families default, it can trigger a domino effect: rental instability, credit downgrades, even tax arrears. Over time, this can erode local economies and community stability. Finally, there's a bigger macro risk. With over 1 million mortgages up for renewal in 2025, regulators might step in with tougher rules or longer repayment terms. That could restrict credit even more. So, what could help? Policy interventions like targeted mortgage relief or refinancing assistance could ease the pressure for the most vulnerable. Lenders may also ramp up loss mitigation efforts, offering options like loan modifications or payment deferrals. And investors will be watching for distressed listings that signal further trouble or an opportunity. To sum up, Toronto's mortgage delinquency rate isn't just rising, it's spiking faster than any time in the last decade. Renewal shock, market illiquidity, rising household debt, and riskier lending practices are all contributing. While the numbers might seem low, the rapid pace of increase and the underlying financial strain are warning signs. Without timely action from lenders and policymakers, the risks could spill over, impacting property values, credit access, and household stability across the city. Stay informed, and if you're facing mortgage strain, talk to a financial advisor as soon as possible.